Stop thinking about Bitcoin as digital gold. It isn't. In March 2023, the financial system started to crack. Silicon Valley Bank collapsed, panic spread, and for a moment, the world held its breath. In that crisis, Bitcoin and gold both rallied, but in fundamentally different ways. And that difference revealed a flaw in a 5,000-year-old story. If you treat Bitcoin like gold, you will misread the markets and get positioned for the wrong outcome. The real question isn't whether Bitcoin is the new gold. It's why they behaved so differently, and what that tells us about the future of money. Let's go back to March 2023. The banking system was teetering. To prevent a full-blown meltdown, the US Federal Reserve was forced to inject emergency liquidity into the system through a new program called the BTFP. It was a classic run-to-safety moment, and as expected, gold did its job. It performed like the seasoned veteran it is, climbing steadily by nearly 8% that month as investors sought a reliable, safe harbor. But Bitcoin's reaction was completely different. The price didn't just climb, it exploded. It violently surged from around $20,000 to over $30,000 in just a few weeks. While gold acted like a stable anchor in the storm, Bitcoin acted like a high-tech barometer, detecting a sudden shift in atmospheric pressure. This wasn't a fluke. It was the market showing us that these two assets are playing entirely different games. For years, the story was simple. Bitcoin is digital gold. The logic made sense. Like gold, it has a fixed supply. No government can just print more of it. It's decentralized, borderless, and exists outside the traditional financial system. For 5 millennia, these traits made gold the ultimate hedge against chaos and currency devaluation. The assumption was that Bitcoin would simply inherit that role for the digital age. People expected it to be a safe haven asset, a place to hide when markets crash. But that's not what happened. The 2023 banking scare, along with the chaos of the years prior, proved that thesis is broken. Bitcoin is not a direct replacement for gold's role as the ultimate safe haven. So what is it? To understand the difference, you have to stop thinking about safety and start thinking about liquidity. Imagine global finance is a giant auction house. Liquidity is the amount of cash sloshing around the room. When the central banks are printing money, the mood is euphoric. People feel rich, and they bid aggressively on risky things they want: art, tech stocks, and crypto. But when panic hits, a banking crisis, a market crash, it's like someone yells fire. People don't care about the art anymore. They drop everything and scramble for the exit, which in finance is cash. They sell what's easiest to sell. Here's what the market just screamed at us. Bitcoin is the most sensitive gauge of global liquidity we have ever seen. Gold is tied to slower moving cycles of inflation and real-world fear. Bitcoin, however, appears to be a direct, high-powered play on the flow of money itself. It's not just digital gold, it's a liquidity instrument. This isn't just a story. The data is stunning. Some analyses show Bitcoin's price moves in the same direction as global liquidity, a staggering 83% of the time over 12-month periods. One analysis from May 2013 to July 2024 even found a long-term correlation of 0.94. For context, a perfect 1.0 means two things move in lockstep. A 0.94 correlation suggests the main force driving Bitcoin's price over the long run is simply the expansion and contraction of the global money supply. But here's the crucial pattern. Bitcoin's price has historically tended to lag changes in global liquidity by roughly 2 months. We saw this play out perfectly. The massive money printing of 2020 was followed by Bitcoin's historic bull run about 2 months later. The start of monetary tightening in 2022 was followed by the crypto market collapse roughly 2 months later. And the emergency liquidity injection in March 2023 was followed by that immediate, powerful Bitcoin rally. And this is the exact point where most people get it wrong. They see Bitcoin rally during a banking crisis and think, see, it's a safe haven. They see it fall and say, see, it's a failed risk asset. Both are wrong. They're mistaking the symptom for the cause. Understanding this mechanism is the difference between protecting your wealth and missing the single biggest driver of upside. If you grasp that Bitcoin is reacting to liquidity, not just fear, you are already ahead of most investors who are still stuck debating digital gold. So, does this make Bitcoin a failure? As digital gold, the answer is yes. The digital gold story was based on it being a safe haven asset, but the data clearly shows that's not its primary role. During a real market panic, where cash is king, Bitcoin has often acted like a high-risk asset. It tends to sell off hard with stocks, like in 2022. That's because when there's a desperate scramble for cash, investors sell their most liquid assets first. Gold, on the other hand, is the more reliable anchor during those moments. But this failure has revealed something far more interesting. Bitcoin isn't a lesser version of gold, it's an entirely new type of asset. It's not a defensive shield, it's an offensive weapon. Here's the revelation. Bitcoin is the world's first global decentralized instrument for betting on monetary policy. Its price is the clearest signal we have for the expansion and contraction of global liquidity. For 5,000 years, if you thought governments were devaluing money, you bought gold. Now there's a digitally native asset that responds faster and more aggressively to that very action. So how do you use this information? You stop thinking Bitcoin versus gold and start thinking Bitcoin and gold. You use them for two different jobs. Think of it as gold for stability, crypto for upside. Gold is the bedrock. It's your strategic insurance against deep systemic shocks. Its slow, steady nature provides a defensive anchor that has a 5-millennium track record. Bitcoin is your tactical play. It's your high-powered offensive exposure to the global liquidity cycle. A smaller, deliberate allocation here is a bet on monetary expansion. When central banks inevitably turn on the money spigots, an asset like Bitcoin is designed to react. This framework shifts you from being a victim of central bank policy to someone who can position for it. During periods of expanding liquidity, you know Bitcoin is built to outperform. During a sudden panic and dash for cash, you know it's likely to drop first as people sell liquid assets. You're using gold to be shielded from the storm, while using Bitcoin to harness the storm's energy. That's a power no investor in history has ever had before. If you're the kind of person who wants to understand the system that moves markets, not just the headlines, then subscribe. My goal is to give you the framework to see the why behind the price. For 5,000 years, gold was the law of money. But the world has been rewritten. The recent cycles of chaos were a global stress test, and the results are in. Bitcoin responds to the tidal waves of modern liquidity with a speed gold simply can't match. It failed as a replacement for gold, but in doing so, it revealed its true purpose. Gold's 5,000-year role as the ultimate stable anchor remains intact. But we now live in a world with two poles of hard money, the physical and the digital. One is an anchor of stability. The other, a hypersensitive gauge of liquidity. The throne is no longer occupied by a single king. And the liquidity cycle that drives this new world is far from over. This is one of those ideas that's easier to see when you can walk through the data.